The $18.7 billion takeover offer for Origin Energy by Canada's Brookfield and EIG started way back in March, so more than 7 months ago. It's cleared the competition regulator, the ACCC, but it still has to clear the Origin shareholders, who'll vote on the deal in late November. But the job of winning that takeover has been made harder for Brookfield and EIG after AustralianSuper, our biggest super fund, said it will vote its holding of 13.67% of the shares against the deal. So, which way does this go? Adrian Atkins is a senior equity analyst for Morningstar who covers utilities and joins me now. Adrian, thanks for your time. Clearly the shareholders want more money. Are they going to get it?
Well, I think Brookfield would be very keen to get this deal done. I think the main obstacle, though, is that some of these big shareholders want a very significant increase in the offer. It's not just a matter of a few percent. I think if Brookfield wants to do a deal, it's going to be closer to $10, I'd say.
So let's think about this, because the offer price is $8.80. The share price is hovering around $9. So clearly that implies that shareholders think there's likely to be a higher bid. The question is whether it's big enough to win, because if it doesn't happen, clearly the Origin share price falls back pretty sharply afterwards.
Yeah, well, look, I don't actually think the share price will fall that much. You know, my underlying fair value estimate is $8.50. So if that's anything to go by, then, you know, I wouldn't expect the share price to fall more than a few percent from where it is currently. It's got pretty good valuation support, mid-teen PE ratio, solid dividend yield of, I think, about 5.5%. So it doesn't look expensive. So I don't think if the deal falls over, there's that much downside. But yeah, clearly the share price is suggesting that investors think that a higher offer is needed.
But one aspect of this that always interests me is that Brookfield, being a big investor, clearly sees a very significant long-term future for Origin. It also says it's prepared to put an extra $20 billion into the company to basically help to fund the energy transition. So that being the case, Australian shareholders could technically also do that and therefore enjoy the future dividends from the energy transition. And that, in a sense, might be a bit behind where AustralianSuper's thinking right now.
Yeah, that's right. Origin already plans to invest a lot of money in renewable energy and batteries. It's got a very strong balance sheet nowadays, so it is actually pretty well placed. So you can argue Brookfield might do more of it, but certainly Origin and its investors are going to do quite a lot on their own.
So Brookfield and EIG, being a private equity player, effectively a big investment fund, you know, now we see the trend for Australian superannuation funds to even take companies off the stock exchange. Think Sydney Airport as being one classic example of that. But the big issue here is, of course, if they let this go to Brookfield, then AustralianSuper and other big Australian superannuation funds have fewer opportunities to invest in to get those same benefits.
Yeah, that's right. And so I guess they're incentivized not to give it away too cheaply.
So that is true. All right, then go to Origin itself, because Origin is going through something of a transition itself as it moves more to the renewable energy. And, you know, and the Eraring power station has got, you know, a deadline for when it will close. So its own performance yesterday showed that compared with this time last year, some of its gas sales were down, some of the prices were down. But that, of course, is the here and now. It's not where it goes to in the future.
Yeah, that's right. I wouldn't worry too much about one quarter. I think, you know, earnings guidance was provided at the last results, and it shows that profits should be up by a decent amount in FY24. So, you know, things are going pretty well overall for the business.
Okay, so then just explain to me what Origin looks like if it is not taken over. You say it's already got plans to invest, but is it a different business? Is it an emboldened business? Does it have to go faster, grow faster to satisfy shareholders who have said no to this takeover offer?
I don't think they will change their strategy that much. You know, they already had a strategy of transitioning to renewable energy. So the coal-fired power station will close down sometime over the medium term. They're building more renewable energy, batteries, perhaps even pumped hydro over the longer term. So I think they'll just continue with that strategy. It's the same strategy as AGL. It's supported by banks. It's supported by the government. So I think that that's the way they'll go. And they should have pretty good support from their investors if they need to raise money. Though it's not my base case. I think they're pretty strong balance sheet. They can fund a lot of that investment by themselves.
So just a quick and final one. You see, say, Mike Cannon-Brookes buying into AGL. You see Brookfield originally have a go with him at AGL and then suddenly withdraws and then goes for Origin itself. When this energy transition goes through, it does sort of tell you, doesn't it, that some of the smart minds believe that there's decent returns long term in this very sector where right now there have been historically problems.
Yeah, I guess it does because there is a tremendous amount of money that needs to be invested, and you expect a decent return on that. I guess what that means for us, the ratepayers, is it's probably going to be higher for longer in terms of electricity prices.
There you go. Adrian Atkins, Senior Equity Analyst at Morningstar. Many thanks for your time on the program today.
No problem.